Right now, in this exact moment, something is happening in the silver market that almost nobody is watching closely enough. A war is raging between the United States and Iran. Missiles are falling, oil routes are choking, and yet silver, the metal that is supposed to protect wealth during chaos, is doing the opposite of what every textbook says it should do. Somewhere between the Strait of Hormuz and the trading floors of New York, a mechanism is quietly rewriting the rules of the precious metals market. And the people who understand this mechanism first will be the ones positioned to act, while everyone else is still confused by the headlines. Because what is coming next for silver is not what most investors expect. Stay until the end, because the final scenario in this analysis changes everything. Welcome to Stick Zennn. Now, if you are the kind of person who reads the news carefully, who does not just believe the first headline they see, who wants to actually understand what is happening to their money before it happens to them, then you already belong here. This channel is built for people exactly like you. So before we go further, I want to ask you for something. Just one small thing. You know how, in the old days, a good neighbor would tap you on the shoulder and say, "Hey, listen to this. You need to know this before it is too late." That is what this channel tries to do for you, every single time. So if that sounds like something worth keeping close, press that subscribe button. It costs you nothing. But it means you will not miss the next warning when it matters most. And one more thing, I am curious, where in the world are you watching this from today? Type your city, your country, down in the comments below. I read every single one. Now, let us go back to where we left off, because the story of silver and this war is only just beginning. He had built his portfolio the same way his father taught him. Buy metal when the world grows dangerous, because metal remembers what paper money forgets. So when the missiles began falling between the United States and Iran, he expected silver to rise. That is what history had always shown him. War brings fear. Fear brings buyers. Buyers push prices up. But this time, something was different. In the middle of July 2026, silver did not rise. It fell. It dropped more than 2% in a single day, sliding down to around $57.52 an ounce. This happened right after the United States carried out a naval blockade, followed by airstrikes, actions that Iran called an act of illegal aggression. For an ordinary investor watching the news, this made no sense. A war was expanding, tensions were rising by the hour, and yet the metal that was supposed to protect wealth during chaos was losing value instead of gaining it. He was not alone in his confusion. Traders across the world were asking the same question. Analysts were staring at their screens, trying to explain a pattern that broke every rule they had learned. Because the truth, the real truth behind this story, was more complicated than fear versus greed. Silver was not failing as a safe haven. Its nature had not changed. What had changed was the machine working underneath it, a hidden economic chain reaction, one that was quietly overpowering the very fear that should have pushed silver higher. This chain reaction had a name among serious economists. They called it the oil inflation rate hike chain. And once a person understood how it worked, the entire mystery of falling silver during a rising war began to make sense. Oil was the trigger. Every time the war escalated, oil prices jumped. Higher oil prices meant higher costs for everything: transportation, manufacturing, energy. This pushed inflation upward across the global economy, and when inflation rises, central banks respond in only one way. They raise interest rates to fight it. Higher interest rates change everything for precious metals. Silver does not pay interest. It does not generate income like a bond or a savings account. So when interest rates climb, holding silver becomes less attractive compared to holding cash or government debt that now pays more. This was the invisible force crushing silver, even while war raged in the background. And the scale of this move was not small. Since the conflict began escalating, silver had already suffered a massive correction. It fell nearly 50%, dropping from a high near $121 an ounce, all the way down to around $61. Think about that for a moment. Nearly half the value erased, not because silver had become worthless, but because a war-driven economic machine had temporarily silenced its safe haven power. For the average person, this looked like chaos. For someone who understood the mechanism, it looked like an opportunity waiting to be studied carefully. Because history has shown, again and again, that mechanisms like this do not last forever. They shift, they reverse, and when they do, the metals that were pushed down the hardest often rise the fastest. But to understand when that shift might come, one must first understand exactly how deep this mechanism runs, and how far it can still push silver down before the tide finally turns. She had spent years studying financial charts, but nothing prepared her for the pattern she saw forming in April 2026. It started with a single number. On April 2nd, Following a fresh wave of escalation in the war, oil prices surged by more than 12% in a single move. Not a slow climb, a sudden jump. The kind that sends shockwaves through every corner of the global economy at once. At the very same time, something else was happening. Something most casual investors never even noticed. The yield on the United States 10-year Treasury bond climbed to 4.37%. Two numbers, one day. And together, they told a story far bigger than either one alone. Because oil and Treasury yields are not separate stories, they are connected by an invisible chain, one link pulling the next, until the entire economy feels the pressure. Here is how it worked. When oil prices spike, the cost of almost everything rises with it. Shipping costs rise, manufacturing costs rise. Even the electricity bill of a small factory owner somewhere far from the war zone begins to climb. This is called inflation, and once it starts moving quickly, it does not stay contained in one industry. It spreads. Central banks exist to fight inflation. That is their primary job. So when inflation expectations accelerate this fast, central banks are forced to respond with tighter monetary policy, meaning higher interest rates. And this is where the second major shift entered the picture, a shift few people outside financial circles were paying close attention to. Kevin Warsh had taken over as the chair of the Federal Reserve. His approach was nothing like his predecessor, Jerome Powell, where Powell often gave the markets long warnings and gentle guidance before making changes. Warsh moved differently. He gave less forward guidance. He showed a much stronger commitment to crushing inflation quickly, even if it meant surprising the markets. After his very first policy meeting as chair, something shifted in how traders priced the future. Markets began expecting at least one more interest rate increase before the end of 2026. For silver, this combination was devastating. Higher interest rates create two separate forces, both pushing in the same direction, both working against precious metals at the same time. The first force is simple. Silver earns no interest. It just sits there waiting, holding its value. But when interest rates rise, cash and government bonds start paying more. So money that might have flowed into silver flows into interest-paying assets instead. The second force is about the value of the dollar itself. When the Federal Reserve raises rates more aggressively than other central banks around the world, it widens what is called the rate differential. This makes the US dollar more attractive to hold compared to other currencies. And here's the part that surprises most people. Silver, like most commodities, is priced in dollars. When the dollar grows stronger, it takes fewer dollars to buy the same ounce of silver, so the price falls, even if nothing about silver's actual supply or demand has changed. Oil driving inflation, inflation forcing rate hikes strengthening the dollar, a stronger dollar crushing silver's price. 4 steps, one chain, and a war in the Middle East sitting quietly at the very beginning of it, setting the entire sequence into motion. She realized something important as she traced this chain from beginning to end. This was not random market noise. This was not panic. This was a predictable, repeatable mechanism, one that had a beginning, a middle, and eventually an end. Because mechanisms like this cannot run forever. Wars shift, policies shift, and somewhere beneath this entire chain, a very different force was already building, one strong enough to eventually turn everything around. He had been mining silver for almost 20 years, and he had never seen numbers quite like the ones sitting in front of him now. While the headlines focused entirely on missiles and blockades and oil tankers, a quieter story was unfolding underground, in refineries, in solar panel factories, in places the war had barely touched at all. The Silver Institute had released a forecast that most casual investors would never even see. A shortage of approximately 67 million ounces was expected for 2026. Not a small gap, a structural deficit, meaning the world was consuming far more silver than it was mining out of the ground. This was the part of the story that the short-term panic around interest rates and oil prices had almost completely buried. Because while the war was busy pulling silver's price downward through its financial mechanism, something else, something slower and far more powerful, was building pressure from underneath. Silver was not just a monetary metal, it was an industrial one. And 2 industries in particular were consuming it faster than the world could replace it. Solar energy was the first. Every solar panel manufactured on Earth required silver paste to conduct electricity efficiently. As countries raced to expand renewable energy, often for reasons that had nothing to do with war or geopolitics at all, the demand for silver kept climbing quietly in the background. Electronics was the second. From smartphones to electric vehicles to medical devices, silver's unique properties made it almost impossible to fully replace. Every year, new technology meant new demand. Demand that did not pause just because interest rates had gone up. He understood something that most short-term traders seemed to be missing entirely. A financial mechanism, like the one driven by oil and inflation and Federal Reserve policy, could push a price down for months, sometimes longer. But it could not manufacture silver out of thin air. It could not close a supply deficit that had already been building for years. Eventually, physical scarcity always finds a way to matter again. There was another piece of this puzzle, one that gave serious investors a mathematical way to measure just how far silver might eventually move once the pressure lifted. It was called the gold-silver ratio. Throughout history, gold and silver have traded in a relationship with each other, a ratio that tends to return to certain historical norms over time, even after periods of extreme distortion. If gold reached the institutional price targets many analysts were forecasting, somewhere between $5,500 and $6,000 per ounce by the end of 2026, and if the ratio between gold and silver compressed back toward its historical norm of around 50 to 1, then silver would not just recover, it would be mathematically required to rise well above $100 an ounce. This was not speculation built on hope. It was a relationship rooted in decades of market history, one that had reasserted itself again and again after periods of extreme divergence. He thought about what this meant for someone watching the market today, someone who only saw the falling price and felt fear, without understanding what was building beneath the surface. The war was creating a temporary suppression, a financial fog thick enough to hide the underlying fundamentals from view. But fog does not last forever. Supply deficits do not disappear because a central bank raised interest rates. Industrial demand does not pause because oil prices spiked for a few months. Somewhere beneath the noise of missiles and blockades and monetary policy meetings, the real story of silver was still being written by scarcity itself. And scarcity, unlike war, does not negotiate. It does not pause for ceasefires. It simply waits, patiently, until the financial pressure finally lifts and the true value beneath the surface is forced back into the light. She had learned over many years of watching markets that the most dangerous moment for any investor was not during the storm itself, but in the silence right before the wind changed direction. That silence was exactly where the silver market stood now. Two paths lay ahead, and understanding both was the only way to prepare for whichever one the world chose to walk down. The first path was escalation. History had already shown what this looked like. Earlier in the war, after joint strikes between the United States and Israel led to the death of Iran's supreme leader, silver had climbed nearly 2% in a single day, rising above $95 an ounce. That same event triggered the effective closure of the Strait of Hormuz, a narrow passage responsible for roughly 1/5 of the entire world's oil shipments. When a choke point like that closes, the effects do not stay contained to one region. Oil flow slows, prices spike instantly, fear spreads through markets within hours, not days. This was proof of something important. Even while the oil inflation rate chain was working to suppress silver's price, a large enough shock could still override that mechanism, at least temporarily. Sudden fear could still send buyers rushing towards safety, even if the deeper financial pressure had not gone away. If the war expanded further, if new fronts opened, if the blockade tightened, this pattern could repeat itself, potentially with even greater force. But there was a second path, a quieter one, and in many ways, a more powerful one for long-term investors. Negotiations, a ceasefire, an end to the immediate danger. This might seem, on the surface, like it would be bad news for silver. Less fear should mean less safe haven demand. But the market had already shown something surprising. Expectations of peace talks between the United States and Iran had themselves supported a continuous rise in silver prices, even before any agreement was actually reached. Why would this happen? Because a ceasefire does not remove the deeper structural forces still supporting silver. It does not fill the 67 million ounce supply deficit. It does not slow the growing demand from solar energy and electronics. What a ceasefire does remove is the oil shock. And once oil prices stabilize, the entire chain reaction that had been crushing silver begins to unwind in reverse. Lower oil prices, slower inflation, less pressure on central banks to keep raising rates, a weaker case for a stronger dollar. And with that, the four-step mechanism that had suppressed silver for months would finally lose its grip. She thought about what this meant for someone trying to make a decision today, not after the fact, not once the outcome was already obvious to everyone. One well-known figure in the metals industry, a retired analyst with decades of experience reading these exact patterns, had already made his position clear. He recommended buying silver now, with a plan to buy more if prices moved lower still. He pointed to a possible move back toward previous highs near $89, a gain of roughly 50% from levels seen at the time. This was not a guarantee. Markets rarely offer guarantees, but it was a calculated position, built on understanding both paths at once, rather than waiting to see which one the headlines confirmed first. Because that was the real lesson hidden inside this entire story. The war had created two forces pulling against each other. A short-term financial mechanism pushing silver down, a long-term structural reality pushing silver up. For months, the first force had been winning, but forces like that do not win forever. Wars end, interest rate cycles turn, central bank chairs eventually shift their stance again. Supply deficits, on the other hand, do not simply disappear. She closed her notes with a single thought, one she believed every serious investor needed to sit with carefully. The people who understood this mechanism early, who separated the noise of war from the mathematics of scarcity, would not be the ones caught by surprise when silver's true value finally broke back through to the surface. They would already be positioned quietly, long before everyone else noticed the shift had even begun.